So some pretty positive news there for the Treasurer this morning. The S&P Global Ratings upgrading its outlook on Australia's AAA debt rating.
Yeah, Peter, good morning. It was a really welcome bit of news, of course. And on the back of an amazingly fast and strong recovery economically, GDP ahead of where it was pre-COVID, employment, the number of Australians employed ahead of where it was pre-COVID. We really came out of this with a full sail. And this is really important for us economically, but it's also important, as you say, for the cost of debt. So the AAA rating, look, it's a nice bragging rights. That's always good for a government to go to an election with it. Most importantly for the rest of us, it impacts the price of government debt. It impacts the price of bank debt. And so when you think about the impact on that, it goes right through to mortgages effectively and pretty much everywhere in between. So this is really good for the country. It does give us some sense that we are back in a good position. I have to say, though, $100 billion worth of debt later is an amazing change in the world circumstance. I dare say 18 months ago, if we'd had that debt, S&P would have been a little more concerned. It just goes to show where we are now, that you can take on that much debt and deficit and still have a AAA credit rating with a rating of stable, and it's good news for the economy.
On to Austrac, Scott. It's launched a money laundering blitz, and you can tell the banks took a bit of a whack yesterday, in particular the NAB.
It did, down 3%, Peter. This was, look, Austrac is probably, it was written up the AFA yesterday as the most feared regulator. I think that's probably pretty right. Austrac don't miss. Commonwealth Bank, Westpac have scars from their dalliances with Austrac. And frankly, Austrac tend to do the job only when they know they've got sufficient evidence or overwhelming evidence. NAB was in the sights, Crown, Star and Sky City, the three casino operators, also in the gun. This is very much a story of, and NAB, by the way, have said since 2017 that they knew they had some concerns, what the Boffins called contingent liabilities, that is potential risk or potential costs should certain things happen. That happened yesterday, and the shares were down 3% as a result.
Are you expecting it to bounce back today, Scott?
I don't do forecasts. I have no idea where the share price will go. I do think it's probably overdone, quite honestly. The fine will be massive if it comes. But if you think about the long-term earning power of the banks, is now really worth 3% less over the rest of history just because of one decision? I doubt it very much.
Yeah. Okay. On to the bond markets. It's tipped. We might be having a connection issue here with Scott. We'll try one more question, Scott. We've got the bond market. It's tipped 4 rate rises by 2024.
Yeah, that's right. 1.1% is the expected interest rate by then. Of course, 0.1% now. Again, talking about the recovery, this has been the theme right through this morning, is the recovery market saying, look, the RBA to go. And when it goes, it probably will go back in some sort of flipping the switch style back to more normal rates. Of course, we forget very easily that 0.1% are emergency levels, so described by the RBA itself and by other central banks. Once the RBA realises the coast is clear, they're going to want to take us back to normal rates pretty quickly. And so, as I said, the bond market pretty much saying once we start to go, we're going to go and keep going, possibly as high as 1% or 1.1% sooner rather than later.
Wow, what's that going to do for repayments?
This is the real risk, Peter. And if you think about what's going to impact the households, the RBA can only go up as much as it knows it can get away with without causing recession or house price pain. But if you think about the impact of that, it takes a 2% rate to 3%. It takes 3% to 4%. The maths there are pretty stunning if you think about the size of the interest burden that gets put on those mortgages. So it will go up and go up meaningfully, hundreds of dollars a month for most people.
Yeah, so you want to hammer down that mortgage before 2024, Scott.
And fixed rate if you can. Well, it'll be harder to find longer-term fixed rates that are low, because if you look out over a 3 or a 5-year rate, we're now rolling into that 2024 date. So you want to be in a place where you can pay up as much as you can, as you say, and probably the longer you can lock in for the best possible rate, I think it's probably in your interest, yeah.
Really good point. Time flies too. 2024 will be here before you know it. Scott Phillips, always good to chat. We'll talk to you soon.